Have you ever felt like money slips through your fingers no matter how hard you work? Or maybe you've wondered, why do some people seem to build wealth so easily while others are stuck living paycheck to paycheck? The truth is, financial success isn't about luck, it's about knowledge. In this video, we're breaking down the core finance basics everyone should know. Whether you're 18 or 48, these are timeless principles that will help you save more, spend smarter, invest with confidence, and build long-term wealth. Stick around because by the end of this video, you'll have a clear roadmap to master your money, something most schools never teach you. Most people go through life working hard, but they never really learn how money works. Here's a fact. 78% of adults in the UK and US live paycheck to paycheck. That means if their income stopped for even a month, they'd struggle to pay bills. Many of us were never taught the fundamentals of personal finance: how to budget, how to save, how to invest, how to use debt wisely, and how to protect ourselves with insurance. Without these basics, it's like trying to build a house without a foundation. Think of it this way: money is a tool. If you don't know how to use it, you'll always feel stressed, no matter how much you earn. But once you understand it, money becomes something that works for you, not against you. The first rule of personal finance is simple: spend less than you earn. Spending more than you earn leads to debt, while spending exactly what you earn keeps you stagnant. Building wealth requires consistently spending less than you make. For instance, if you earn $2,500 a month and spend $2,600, you'll fall deeper into debt. If you spend exactly what you earn, you'll remain stagnant. However, if you spend $2,000 and save $500, you move closer to financial freedom. Beware of lifestyle creep, where increased earnings lead to increased spending. Wealth is built not from spending, but from saving. Automate your savings by setting up automatic transfers to pay yourself first. Budgeting isn't about restriction, it's about giving every pound a purpose. The 50-30-20 rule helps maintain balance in your budget. Budgeting allows for enjoyable living while still prioritizing your future. Alternative budgeting methods include zero-based budgeting, where every pound has a job. An emergency fund is essential for life's unpredictable moments. Start small with a goal of saving $500 to $1,000 before building up to 3 to 6 months of expenses. This fund grants you peace of mind, helping avoid financial disasters. Debt isn't always bad. The key is understanding the difference between good debt and bad debt. Bad debt includes high-interest loans used for items that lose value, like credit card debt for clothes or payday loans. In contrast, good debt consists of low-interest loans that help build wealth, such as student loans, mortgages, or business loans. For example, a $5,000 holiday on a credit card at 20% interest could lead to financial disaster. Conversely, a $150,000 mortgage at 4% interest represents an investment in a home you live in. A crucial tip is to pay off high-interest debt first to improve financial health. You can use the snowball method to tackle the smallest debts first for motivation. Alternatively, the avalanche method prioritizes paying the highest interest debts first to save money in the long run. Albert Einstein famously called compound interest the eighth wonder of the world. If you invest $200 per month from age 25 at a 7% annual return, by 65 you could amass over $500,000. However, if you wait until 35 to start, your total could drop to around $240,000. The lesson is clear: start early, because time in the market beats timing the market. Automate your investments as if they were a bill owed to your future self. Once you've eliminated high-interest debt and built some savings, it's time to invest. The big three basics of investing are stocks, bonds, and cash or savings. Stocks represent ownership in companies and typically come with higher risk and higher rewards. Bonds involve lending to governments or companies, offering lower risk and lower rewards. Cash and savings are safe but often yield low returns and may lose value due to inflation. Diversification is crucial. Don't put all your eggs in one basket. Many investors choose index funds or ETFs to spread their investments across hundreds of companies. For example, investing $10,000 into the S&P 500 20 years ago would today be worth over $60,000. Most people underestimate how much they'll need in retirement. State pensions are rarely enough. In the UK, the full state pension is about $11,500 per year, yet average expenses in retirement are closer to $20,000, $30,000 per year. That gap has to be filled by your own savings or workplace pension. Contribute enough to get your employer's match. It's literally free money. Building wealth isn't just about making money, it's about protecting it. Insurance transforms a potential financial catastrophe into a manageable monthly expense. Even if you know the basics, there are traps to avoid. Keeping up with the Joneses often leads to unnecessary spending. Subscription creep can add up quickly. Impulse spending is often driven by emotion rather than necessity. The 24-hour rule can help mitigate spontaneous purchases. Building wealth involves creating sustainable financial habits. Track your spending monthly and review your budget quarterly. Increase savings with each raise instead of upgrading your lifestyle. Finance isn't static. Keep learning and adapting. Think of money like fitness. Consistent actions yield big results over time. Master the basics of financial management to ease stress and secure your future. Remember, consistency is key, not perfection. Which of these basics do you feel most confident about, and which one do you want to improve? Financial freedom isn't about luck. It's about learning the basics and taking action.